So welcome to the MSX discussion for the first half of 2023. And once again, apologies for the slide delay because of technical. My name is Hassan Al-Lawati, and I'm the Chief Executive Officer of Oman Qatar Insurance Company. With me in the boardroom, I've got Chief Business Officer Ali Abdul Azim. I've got Mohammed Jawad, Chief Financial Officer, and I've got Omar Al-Shamfari, our Senior Manager, HR, Admin and Government Relationship. And we've got our colleagues also on the call, Compliance, Finance, and IT. With that, we'll kick off the discussion. The agenda for today that will walk you through, the board of directors of OQIC. You all know that we have undergone a merger with the Vision Insurance Company. We'll walk you through the management, the organization chart. Then we'll highlight the financial for the first half of the year and compare it with the last year in details. Then we'll walk you through the investment details. And finally, what's the status update and the implication of IFRS 17. And then finally, we'll open room for questions and answers. To begin with, board of directors, there is no change except for Mr. Abdullah Khalil Al-Kunji, who joined us this year. And then he's also chairing the investment committee and is a member in the audit, risk and compliance committee. In terms of the management, sorry, are we audible?
Yes.
Looks like we have here.
Slightly there is.
Okay, so in terms of the top management of OQIC, I've introduced the gentlemen in this room. Go to the next slide. So let's start with the snapshot of the financial performance. Sorry, we have slight issues here, sorry. Bear with us. All right, so in terms of the gross written premium and the first half of 2023, we have produced 35.7 million Omani Riyals compared to 18.9 million Riyals last year. You can see that in 2022 full year, the total GWP was 37.7 million. In terms of the underwriting income this year, for the first half, we produced 1.9 million. And this is the consolidated figures that we are sharing with you post-merger. Last year, full year, we did 2.9. And last year, OQIC standalone for the first 6 months produced 1.6 million Omani Riyals. In terms of the profit after tax, which includes investment as well, is 1.2 million for the first 6 months of 2023 versus 2.9 million full year in 2022. And the investment income, 1.6 million in the first half of the year versus 3.1 million full year last year. Now, we'll dig into a bit more details into the financials, and I'll here hand over to our CFO to walk you through.
Yeah, hi. Regarding the detailed financials for H1 2023 compared to H1 2022 and the variances and reasons behind that. So let's start with the gross written premium. So in H1 2023, we have approached 35.6 million in 6 months 2023 compared to 18.9 million. And this is representing 89% increase in top line. Majorly, we can see a huge contribution from medical business, property, and casual diseases. Going to net underwriting income, the company approached 1.85 million compared to 1.68 million in 2022 6 months. So this is 10% by itself increase in net underwriting income. Majorly, this is due to increase in retention ratio in certain profitable lines the company decided to go with. Going to the general and administrative expenses, we can see an increase of 132% compared to 2022 6 months. This is mainly due to the expansion in top line and business and certain merger related expenses, which are divided into two sections. One is the one-offs, which we need to expense during this year as per IFRS standards, that merger expenses need to be expensed in the first year, in the same year, and some related to the new entity formation and the expenses of adding vision expenses to our books and reporting consolidated financials, consolidated expenses. Moving to the investment income and other income, we have 2.4 million compared to 1.7 million. So the company investment books increased after the merger, and we can see that out of 2.41 million, to be precise, we have around 800,000 riyal sitting as a purchase price, waiting for purchase price allocation, which will be completed during the remaining 3 months of the year. So that gives us a net profit after tax, before tax, 1.29 million compared to 2 million. So this is majorly related to the expenses, which will be corrected in the coming month. So obviously in the first year of the merger, all the expenses will come, and then a lot of corrections and measures the company is taking to reach to the ultimate target of ideal expenses, considering the size of the business and manpower. This gives us a net profit after tax of 1.2 million, almost compared to 1.8 million. Which is 37% lower. Going to the gross written premium mix and underwriting income mix, we can see that in 2023, which is the darker color than 2022 in GWP mix, we can see that medical business, life and medical business, jumped from 17% to 42%. So the company is focusing currently to enhance the life and medical book and earn a high profitability in this line of business. We can notice that property business was 51% in 2022, and now it is 31%. So this is giving a direct insight that the company tries to distribute the GWP mix across all lines of businesses. When we go to underwriting income, we can see that underwriting income from property line, for example, in 2023 is 63% compared to 32% in 2022. So that is mainly due to selective of right profitable accounts the company is writing and prudent underwriting strategies we are following. We can see that retail was contributing 41% in 2022, and now it's contributing 5%. And this is mainly due to the increase in other lines of businesses and the underwriting income from those lines. Retail. Moving to the investment details. So in terms of investment portfolio composition and investment income composition, we can see that in H1 2023, the company distributed the investment portfolio 70-30%. So 70% is in fixed deposits and bond and sukuk. And this is a very safe method, and considering the existing yields on fixed income, it is a very profitable arrangement. So we have 70% in fixed deposits and bonds, and 30% in equity investment and mutual funds. If we compare this position with 2022, we can see that 63% was in fixed deposit and bonds and instruments, and the remaining 37% was with equities and mutual funds. This generated an income in 2023, which is 53% from interest income, 837,000 Omani Riyal, and 41% from the dividend income, and realized income is 5% almost. The company is having very limited exposure on rental income, which is related to the building of vision investment, which the company acquired in this year. So if we see the graph on the right-hand side, 2022 investment income, we can see that Interest income was only 25%, and now it is 53%. So this is a big change in the structure of investment income. Moving to the next slide and final slide, which is related to IFRS implication. So IFRS 17 and IFRS 9 came into effect from 1st January 2023. So these two standards will bring a significant change to the insurance industry and the way to calculate insurance revenue and reinsurance contracts and financial instruments. OQIC is ready, and we already implemented IFRS 17 and submitted to the Capital Market Authority on time. And we are waiting for Capital Market Authority guidelines on when to start publishing to the public IFRS 17 figures. So of course, we will publish year-end results based on IFRS 17. The entire insurance industry will present that. And now there is a talk that maybe Q3 will be presented in IFRS 17. So CMA will be very clear on this, and it will be communicated to the industry. So by this, we are ending our presentation, and we are welcoming any question from the public.
Thank you, Mohammed. So this time, we wanted to keep it very, very short and direct, in terms of the performance. We're still in the middle of the consolidation and integration with the business of Vision. But we wanted to open the room for Q&A and have a discussion over there. Yes, Abbas.
Good afternoon. Thank you very much for the call. I have a few questions. The first one is, I think I asked you on the earlier call, when it came to your listing requirements, the free float is less than 25%. And you said that you're talking to CMA and they've given you some sort of time frame to fix that. Any update on that? And what sort of measures are you looking at to increase the free float to 25%, which is the mandatory requirement to be a listed company in Oman?
Yeah, so the mandatory requirement, Abbas, for 25% is excluded when you are having M&A transaction. So when there is an M&A, the percentage can go to lower than 25%. However, we are having discussion with our main shareholders and on this regard, and we are having a plan to increase the free float to reach to 25%.
Okay, and for a merger, I remember in the earlier call also you told me that CMA has given you some sort of relaxation because it's a merger, which is important for sector consolidation. Is there a time frame that they've told you? That is it a 1 year relaxation? Is it a 3 year relaxation? Is there a time frame for that?
You mean to have 25% free float?
Yes. Yeah.
Yeah, no, they didn't give any time frame. As I told you, see, we got a confirmation from CMA that the current structure of our shareholding is acceptable by CMA. So we can continue as we are, and it's our call whether we want to have a higher percentage of free float.
Sure.
So in terms of regulatory requirement, we are compliant now with the existing structure.
Okay, so there's no force for you to come back and issue new shares or let your other shareholders sell shares. There's no conversation like that right now, as of now. Got it. My second question is on the business. It's a pretty interesting year for the sector in general. Profits have come down at an operational level. Investment income is keeping companies afloat. Even in Oman, Qatar's case, when I look at the consolidated numbers, I just wanted to understand from an operating level, if I exclude the G&A expense, net underwriting sort of results, I've noticed in the presentation that you mentioned that you've increased the contribution from the life and medical business, but that's actually led to a loss in the first half. So what's going on the operating side of the business? When I speak to others, everyone's complaining about motor rates being extremely challenging, and loss ratios have gone up substantially in motor, given that life has come back to normal after COVID, sort of driving behavior had changed for 2 years. So what's your experience on your different sort of lines of businesses on an operating level, and what do you see happening in the next 6 to 12 months?
Absolutely. This is a very interesting, question and a big topic in the insurance industry, this year and the plan for next year. So there's a couple of elements here. So element number one, let's not forget that there was a merger and we have integrated our business. we have taken the entire business of Vision because of the merger, right? And now we are forming, our appetite and strategy on where to focus on. Now you have pointed on a very, very important subject, which is the profitability of motor insurance. This is no secret, and if not all, most of the insurance companies are getting badly hit by the performance of motor, right? And we know the reasons. Back during the 2020 and 2021, the COVID year, there was a direction towards reducing the prices for all the obvious reasons, and this is hitting us very badly. When I say us, I'm talking about the industry, right? And there's a lot of debate and discussions going on between every company, at the management level on what to do next. Now, my view is that the pricing will correct itself, because this is not sustainable, and it's not about the impact is not being at the forefront of two companies, but everybody is taking the hit. So that's one. And because of that, we have decided to shift our portfolio. As you know, the commercial lines, these are the lines where the retention ratio is the retention rate, which is the in terms of premiums versus the reinsurance session, is very, very low, right? If you increase your exposure in these lines of business, then you're exposing your bottom line quite heavily, especially in a market where we are exposed to NatCat events and a couple of other regularly we are hearing about some incidents, lost incidents in the commercial lines, be it fire or flood cases. Now we've started to really invest into our life and medical division, and predominantly the medical. We have put the right setup in place. We've got the people, we've got the software, the systems, we understand the business, and we are fully running and managing the business ourselves, so that we're not dealing with any third-party administrator. So what has happened, we have increased our portfolio significantly. So just to share with you some of the figures here. Full year last year in 2022, we have produced a top line of 5.4 million on areas, life and medical, and this is medical specifically. Around 6.1 is with life. This year, for the first half of 2023, we have produced more than 15 million Omani riyals, and that's the focus for us. As a result, we are having a good retention in the medical business. As a result, that in our business, the UPR, the unearned premium, plays quite a major role if you are having significant growth in your net premium. So we're having a big, not a hit, but a big exposure or a big charge of unearned premium for this year, which eventually we're going to earn it as we approach the end of the year. The majority of the growth in our medical business has come in Q1, which means by end of Q4, we would see more realization or more gaining of the UPR. So that's a very important element for OQIC this year. So that's one. Second, if we go to the motor, then we have combined two portfolios, and our focus in the first half of the year, to be honest, up until August, the focus was to make sure that customers are not being impacted because of the merger. So all the front-end systems, all the processes, our distribution channels have remained intact. And I would gladly say that we have been very successful. There have not been much noise, some noise always, right? But no much noise in terms of how we operate and manage for the customers. Second was the people of OQIC, the staff, the onboarding process. That was the focus for us. And third, which is again very, very important, is the technology side of it. So the integration, the migration of data. We have reached really, really far. In less than a month, we will be completing the migration process of the personal lines business, be it on the underwriting or the claim side, and that's a huge, massive achievement, over a span of 6 to 7 months. So this will help us, go into phase 2 of the integration, which basically is scrutinizing the data. So just to make it simple, Abbas, we've got our own reserving methodology when it comes to claims and IBNR calculation, and the X Vision, the legacy Vision, they put their own ways, and we have 2 different portfolios, 2 different exposures, 2 different performance. And now when you merge, so far we have not realized, or we have not gone into a step of realizing the benefit of that merger, except directly allocating whatever expenses of the X Vision or the loss ratios or the IBNR. Now we are getting into a scrutinizing phase where we are merging the 2 books and then unifying the approach and the calculation. And of course, we will not be able to do it without the assistance of external actuaries. So we are in the process of getting finalizing that and getting the right report. So you would appreciate that, Abbas, when you merge 2 policies, especially when it comes to motor, you go through that, and hence you see that the performance. Now, the increase in underwriting income, maybe this was your question. So what is happening? In one hand, you're saying the underwriting income is going up. On the other side, you have a lot of challenges in the market. So this underwriting income includes the business of Vision, and Vision have got some profitable segment as well. Motor was challenging, we all know about that, but they had some profitable lines of business. So the increase in underwriting income is also the contribution of the portfolio of Vision. Right? But if you ask me, is it 1 + 1 = 2, and is it the full realization of the investment of the underwriting income? I would say not yet. We have to wait and see, and mainly we will see that in 2024.
Hassan, thank you so much for a very detailed answer, because some of it you touched upon my next question that was going to be on the merger. But let's break down your business pre-merger. Okay, let's assume there's no synergy right now, and you're in the integration process, and you rightly broke it down. There's step 1 of integration, which has gone according to plan, and there's step 2. And obviously, the entire results of this, will only be seen in 24. I mean, I completely understand that. We're very patient sort of minority shareholders. But when I look at your business right now, and just to reflect my conversation with other CEOs of other insurance companies, one thing that they bring to our attention is, of course, motor is struggling, for everyone. But even on the health side, they're saying it's not a very profitable business on the health side, because we always ask them this question in context of this mandatory health insurance that's, that has been talked about for the last couple of years in Oman. And I think it's only a matter of time before CMA sort of announces it. But those CEOs tell me that they're very cautious about this line of business because medical loss ratios are definitely north of 90% plus historically. In fact, it's not a very profitable business. Now, in that context, when I see your numbers and I see that your contribution from medical has gone up substantially, but you're also, from what I understood in the, when I saw because you don't give detailed breakup in the interim statements, and like some companies will give you, net written premium, and they'll give you underwriting loss or gain, for different lines of businesses, at least motor and non-motor. I think OQIC doesn't do that. That would be a recommendation if you started giving a little more indication, so that you don't have to depend on this call to get those numbers. So now I'm only reflecting back on the slide that you shared. Motor has lost me. Motor you've tackled very well, and you've also mentioned why you're sort of going away. The focus on motor is sort of reducing in your portfolio. But on a medical side, you made losses in the medical side, is what my understanding is based on the slide that you shared. And also, how do you reflect what's happening in the market? At least the other C-levels talking about this being a very challenging portfolio to manage. I mean, what's your comment on specifically medical, sir?
So, to give you, let me just take your comment on the detailed breakdown of the performance. This is well noted, and we'll reflect that in the future. Thank you very much. In terms of the health insurance, at a very high level, I agree with the statement of that medical is perceived to be a loss-making business. But Abbas, let's talk openly here. Now, let's go to the year of 2022 and before, right? You have all the figures about the market. You have all the information from the CMA index that they're publishing every year, right? What is the total size of the health insurance portfolio? Who's dominating the health sector? What are the available, share, which is being split by other players? So if your portfolio is very small, so for example, see whether you produce, whether you have 1% retention or you have 100% retention, the cost, the expense of producing business, managing the business is the same, right? So that's something to be kept in mind. And we are in a business of insurance, so we are in a business of high volume and low of large numbers. So you will see synergies the moment you have a sizable book. And let me talk about OQIC. I'm not going to discuss the performance of other insurance companies. But when our portfolio was small, right, you can't really have any synergy. You can't even discuss any kind of the benefit you get from a portfolio. So very small. One bad account again exposes your portfolio. If you don't have retention, then your expenses is hitting you anyway because you have to service the program, right? What we have done, and I'm not going to open much about here, the details of what we are doing in that segment, but we have clearly identified, ways and areas, and mainly using the technology and specifically artificial intelligence, in helping us run the business. I'll just share with you one, high level kind of, just to give you some sort of indication. If we look at the combined operating ratio of medical for the first half of this year, right, versus the combined ratio that we had in 2022 for a smaller group and the years before, this year is performing better for us. We've identified that. Second, you're reflecting on the -3% underwriting income that from this, and this underwriting income obviously includes the commission element as well on a portfolio which is not fully realized, right? I told you we have a massive portion of UPR. Now you do the calculation. Last year you have done 5 million, 5.4 million full year. This year you have done 15 million in 6 months, right? And you are having a significant retention on that. And I'm happy, let me do high here. 65% is our net retention in medical. Now you do the calculation. Right. What will right? We will see the full realization, as we progress in this year and next year. So, is it overall, a portfolio that you have to be cautious about? 100% yes, right? Are we now investing into this, growing this segment? And we don't see the value? Answer is no. We've identified areas, and we are quite comfortable that this is the space that we are going to see some benefits.
Thank you, Hassan. That's a very well-rounded answer, and that gives some comfort. I see what you're saying now. I can see your point of view as well. So tell me, when with your sort of current capital structure, what sort of premiums can you write in the next couple of years? And you said your current retention ratio in medical is 65%. And I noticed your overall retention ratio is close to 40% for the entire business for the first half. I'm assuming you must be retaining 90-95% on the motor side. Is there any other line of business, thanks to the merger, thanks to the size that you've acquired? I mean, I understand, relatively speaking, it's still a small size. You mentioned the nat cat risk, when it comes to retaining more on any other line. So is this the true focus area, motor and medical, where you're going to retain most of your, in premiums? Is that the strategy for 24?
The strategy for 2024. So motor, for us is a line, rather personal lines, right? And when we say motor, we speak about the corporate motor and the individual motor, right? And then we discuss about some other elements. Now, motor definitely is an important line of business, right? Because whenever you have retention, you need to carefully, grow the book. Otherwise, don't expect any bottom line, right? In insurance. So it is something that we are carefully growing. So we are not expecting, a massive growth. It's just, maybe a couple of percentage, year on year, in terms of growth in top line. And the focus is completely to, analyze the portfolio. And we have, we are now getting the right tools and insights into our portfolio and where to focus in. So that's the focus for 2024. Fix the motor, fix the bottom line. That's the focus. Now, in terms of the top line, life and medical, for sure, is an area of focus and strategy. But not only that. We have, believe it or not, we have, concluded our 3-year strategy towards the end of 2026. We've been discussing with the shareholders and with the board of directors, right? Almost finalized. And we are, at the end of the day, we are a property and casualty insurance company, or let's say commercial lines. We are not deviating. Top line is important, plays a role. You are allocating expenses to these lines of business, so you can't ignore that. So there are other benefits you are getting even from lines where you don't have retention, right? So the focus will always be there. Within the portfolio, I know we've identified as engineering a focus area. Definitely, and we've identified ways. And let's wait until we see the year-end result, and you'll see some good progress. And hopefully, nothing surprising comes as an upset event or a loss event. But engineering is something that we are very careful. We have got a special arrangement with RI exclusive for OQIC for the Omani market. So that's giving us a good advantage and edge in this market. Liability is something that we want to focus in. Where we have to be very, very careful is the property, mainly property, and this is obvious to everybody. And the only way to grow your property is to get into the fronting business, which it's okay to some extent, but not the full, not forming part of our strategy. So we can accommodate. We are operating in this market, but it's not the focus to be just a fronting company.
Got it. Thank you. I had another question. I mean, it's a bit naive because I was going through your notes, and again, you mentioned about the purchase price allocation and recognizing a gain on it, and then you in the presentation you spoke about your G&A expenses, and you said that there are some merger-related one-off expenses. So all I was doing is I was just going back last year and looking at your sort of run rate for quarterly G&A and looking at Vision Insurance quarterly G&A run rates. I don't see a big difference if I add up your two G&A expenses. And let's say for first half of last year, when you guys were independent companies, and I compare it to the consolidated entity that you are right now, I did not see any one-offs standing out to me in the G&A side. So what are these merger-related expenses, and have I missed out something? And my second question is on the purchase price allocation. Is that something that was recognized in the P&L this year, or was that a direct sort of balance sheet entry, this $1 million real gain that you had?
Yeah, Abbas, regarding the expenses, it's a nice comment from your side. So basically, if you add the Vision expenses along with OQIC in 2022, obviously you will see our combined expenses now is not that different from both entities in H1 2022. But the fact here is that we took a lot of efforts to reduce other expenses and to realize whatever synergies we have to cover merger-related expenses. As you are aware, that merger happened by March, we can say effectively. So as on March, we had a lot of expenses related to merger, which need to be accounted for in 2023. So to compensate these expenses and to control the G&A, we made a lot of cost-saving initiatives across the company and across the lines. So that offset the one-offs. So if we don't have one-offs next year, you will see a much better expense base.
So Abba, just to elaborate on this point. So if you just take OQIC expenses standalone versus Vision expenses standalone, plus definitely there are merger expenses that we are predominantly taking in the year 2023 and not the year 2022. So the end result should be a much higher expense base than both companies standalone, right? But in this case, our forecast, we will be closing this year with almost the same expense, which is standalone OQIC and standalone Vision. And the balance, I'm not going to open up much information and tell you exactly how much we have saved at this stage. Maybe we can have that discussion at the end of the year. So when we discuss the full year 2023 performance, I can share that information. So let's put it this way. All the additional expenses that we have incurred in 2023 has been offsetted by the expense synergy that we have realized across different segments, and big part of that is IT.
Wow, that's quite helpful. And how do I look at the purchase price allocation related gain? Is that, I mean, it's a very naive question. How do I sort of account for that? Is that something that's not? Yeah. Yes, Mohammed.
Regarding purchase price allocation, so when any M&A transaction happens, the company is having 1 year as per IFRS to account for purchase price allocation. So we have already appointed external consultant to calculate the purchase price allocation resulted from this merger. So basically, when you buy a company above or below the book value, you will get either a goodwill or a bargain gain. So if you got a bargain gain, you can book that bargain gain in your book as we did currently, and that will be evaluated over 12-month period. So currently we have the last quarter of the year to evaluate the numbers we reported already and get it audited at the end by our external auditor. So who's doing this purchase price allocation, going back to your question, is an external consultant, assessing all the assets we gain, whether there is a goodwill from the transaction, and compared to what we reported as a difference between book value and the transaction price.
And that has not been accounted through P&L, right? The bargain deal gain that you had, that's not been accounted through the first half P&L, right?
It's accounted under other income.
Okay, got it. Okay. And coming back to, I mean, the statement that you made, that's quite the encouraging statement that even though on a consolidated level, your expenses are similar to what it would have been a year ago, just adding the two up, but you've had substantial savings. Now, if I just stretch this question and look at your merger integration, right? I mean, like you said, it's not a 6-month process. It's going to take a year and a half. Is there more cost savings out of this merger? Is there more cost savings to come, or 75-80% of it is already behind us that you've already spoke about? Without giving us a number, you said you've already recognized that sort of savings. So have you achieved most of it, or there's still some way to go, at least on the cost side?
Abbas, you're putting me into a very difficult, conversation. I just had my discussion with the board, so I have to be very careful. What do I commit for 2024 and beyond?
Without giving me, Hassan, honestly, without giving me a number, if you just give me some color, I appreciate it. The idea is to, it's very, the idea is just to appreciate what's happened in the company, and some of it, the numbers are not they tell you until we speak to you, right? So this call is so welcome for me because I had so many questions that I have now got a lot more clarity on, right? Because if I just see the numbers, it doesn't make that much sense to us. So I really welcome these conversations. So thank you for this forum, firstly. And without giving me a number, just in terms of, how you looked at the merger and what sort of synergies are still to be realized. Because this word synergy is thrown around a lot, but it's so difficult to, achieve them, right?
Yeah. So sure. In theory and on all the academic papers, right, we would say that you need 3 years to fully realize, the synergies of such, merger and acquisition, which is all true. So some of them is an immediate saving that you are getting. So whether this is, from a technology point of view, whether this is from a people point of view, we have closed down a couple of branches as well, duplicate branches. We had 2 branches here. And we have efficiently allocated our resources into other departments. So what we are doing now, a lot of internal transfers, and that we have grown our business. So let's not even forget the element of significant growth in our medical business, right? And that requires resources. So our focus was to keep to protect our employees as much as possible. So we have created new jobs internally, and we have transferred these people. Now, if we have not grown our medical business, right, so our expenses will be high. So instead of recruiting more, and this is all aligned with your top line, your net premium, your earned premium. So we have done a lot of internal adjustments and realized that saving in terms of people. IT itself, we have seen some good amounts of savings. We have run off some of the systems. We are not paying the maintenance cost of some of the softwares that Vision had. That also has been realized. In one of the portfolio, the excess of loss, that we are using the OQIC XOL, with that has produced a lot of savings as well for us. Now, what we are showing now, or the final expenses, or whatever you read, is already incurred. The saving incurred, right? So we're not expecting. So we're not forecasting the savings and realizing it now. So this is all actuals. Now, the next phase of savings or realization would be mainly from a technical side. So mainly from directly related to business, and not from the administrative or the structure or infrastructure, I would say.
Got it. Thank you for that. You mentioned something in passing that it stuck with me. You said that Vision's reserving is different than yours, obviously, and you said external actuaries are going to. Is that something that external actuaries are studying? And let's say, I mean, there is no indication of under reserving, right, from Vision's side, because I imagine you did your due diligence, right? There's no risk of under reserving where you'll have to create more reserves. Is that? I mean, I really missed that statement when you talked about the reserving differences between the two companies.
Yeah, so obviously, if you look at if you analyze the portfolio of Vision, it has a very different characteristics of the portfolio of OQIC, which will have a very different characteristics of any other company, right? So we have two different portfolios. And then we've got the history, the claims triangular that you are going to review. It's very different, right? So the IBNR calculation in Vision's portfolio is very, very different, the portfolio of Vision, than what OQIC has, right? So in a nutshell, if I want to immediately incur saving, without getting it technically, verified, I would say, let's all apply the IBNR calculation or methodology of OQIC portfolio into the Vision's portfolio, and that would be a big mistake we do, right? Because we're still living with the outstanding book, claims outstanding of Vision, right? And then we have our own outstanding, which is business as usual. I just give you one aspect of the outstanding, the legal cases, which I'm sure the CEOs of other insurance companies would have very much stressed on, the impact of the legal cases and the bodily injury that is, directly hitting our bottom line in the motor portfolio. So how do we deal with these, kind of cases, right? So we're not saying that Vision was under reserved whatsoever at all. We're saying that there are different methodology of calculating the IBNR and dealing with outstanding than what OQIC is having. The best people would be to analyze and guide us on what is the IBNR that we need to pick or implement for the merged book is the actuaries, right? So we said that let's not come from our side. We need guidance from experts to tell us, to give us insights on. We know what is Vision standalone. We know what is OQIC standalone. But the question is, what is the right way to deal with the outstanding and IBNR when the books are combined? This is one. Second of all, Abbas, now you might ask a question: what is happening with the renewal of Vision? How are you picking the renewal? How are you booking the renewal business of Vision? Right now, we are not using the systems that Vision used to use. So all the new business, all the renewal business of the ex-Vision portfolio is being booked under the OQIC software or application, right? And portal, and it has a different, and we use our own pricing. So the question is, if we are having difference in pricing, which is obvious we have difference in pricing, right? Mainly in the comprehensive, what is the impact of a renewal of Vision that is getting and carrying the pricing of OQIC, right? How is that going to be forecasted for the future? This is a very important aspect. Right. So again, if I run a report from the Premier, which is the Vision system, right? There is no new booking. So how do we calculate the UPR and how do we deal with the reduction in the outstanding claims and the increase in paid claims, because portfolio is running off. That is in the Vision's portfolio. But in OQIC, it's a different challenge. They're having a massive growth in the systems because of the business that is being booked under the OQIC softwares, right? So it will produce a different UPR, different claims and different trend altogether. So it's two different systems until this is fully migrated, and we need a very expert opinion on how to deal with that, so that we don't either inflate or deflate our figures. And we need to continue.
That sounds very reasonable.
Yeah, right. And let's not forget the implication of IFRS 17, which it has a different way of calculating. So definitely we need assistance over there.
I think that makes a lot of sense. And my last question is on your investment book. In a year which is so challenging for the sector, investment book has come to the rescue for most companies. What's your philosophy when you look at your investment book? Currently, you have a 70-30 mix. And, what sort of investment yield you, Hassan and Mohammed, will be comfortable with, where you're saying, hey, listen, we're not here to speculate on this business. If I get an X percentage in this current market, I'm happy. I think we're doing a reasonable job. And secondly, I wanted to relate that to your sponsor, Qatar Insurance. what sort of role do they play? I mean, what's the advantage that Oman Qatar has been part of such a strong regional sponsor, both on the operating and the investment side? And is there anything changing there now that you've acquired this scale? Is there an incentive to do things more in-house? So that would be my last question.
Okay, I'll pick the second part, and then I'll hand over to Mohammed on the investment side. So obviously, okay, they're not sponsored; they're our parent company or the largest investor into OQIC. And let's not forget Al Qasr, 35% share, nearly 35% share in OQIC. So definitely, when you invest and you put money into a transaction like M&A, right, you would be more demanding. You would want to see, the benefit, as soon as possible. QIC themselves, they've got their, board of directors and shareholders, which is sitting, in Qatar. So this is being, addressed on regular basis. I'm having, monthly calls, to go into the nitty-gritty of what's happening. So the expectation is high, but they're very supportive, and they really want to see, their investment, reach, rewards as expected. So they're fully now, available, and they're showing a lot of support, to OQIC in this space. So they're not involved in management whatsoever, absolutely, but then, through board representation and through a task force committee that they have forced alongside the board to regularly monitor the performance of OQIC and what's happening with us. I'll hand over to Hamid.
Abbas, regarding the investment, just to begin answering your question, we are an insurance company that our main philosophy is to protect the shareholders' money and to pay our liabilities to our policyholders. So in terms of our investment, we always, as an investment philosophy, we invest in very secure investments, thinking about long-term returns rather than speculation and trading. So in terms of fixed income, we just monitor the market year on year, quarter on quarter, and see where are the yields heading to. So if you can see the current market now, we are witnessing a very high interest rates on fixed deposits, for example. So it is a right time for everybody to invest in fixed income and enjoy these high returns and lock it for 1, 2, 3 years up to the company philosophy. So this is clear from our investment breakdown. You can see that around 50% is only in fixed deposit, and it is locked at very attractive interest rate. And 27% is in equity investment. These equity investments are precisely selected with proper active management for long-term investment. So we are not entering into any stocks because it's a hype or we just witnessed some upside in these stocks. So our philosophy is long-term investments, selecting a company for long-term, keeping the stock. Once we see any issue in the future, we exit and go into something safe and high dividend payouts. So this is our major philosophy. We are away from any risky investment, even if the return is high. And considering the current returns on fixed income, I guess it is a best decision currently.
Okay, so then you at least in your outlook, you're going to continue with the 70-30 sort of fixed income to equity mix.
Yeah, ideally we will be around these percentages, and we are compliant with the article of investing insurance and takaful companies investments. So in terms of all articles related to investment, we are compliant, and we are seeing a good model of 70-30.
Fair enough. And if you'll allow me one last comment, I mean, Hassan already acknowledged my point that when I look at your notes, there's little less information than what I can find in other insurance companies' notes. Now, for example, the segment breakup, the different lines. So that's one thing. A second comment I just wanted to leave you with, and there's no right answer, but when you look at your balance sheet, normally you don't break down your share capital. For example, you don't break it up into share premium account because you issued shares to Al Hossain at 196. You kind of bunch it as share capital of 22 odd million. Now, for the uninitiated investor, if you just pick up your net worth and you divide by this 22 million, it kind of gives you a much lower book value than you are at close to 220 paisa. This is just a comment. You're not doing anything wrong. But if you just break it up into share premium and share capital, because people normally just look at the share capital, divide by 100 paisa to get the number of shares. This is just a comment I wanted to leave you with, so that the company is fairly reflecting that anyone who picks up a balance sheet knows that the book value is 220 paisa. This is just something I wanted to leave you with. But other than that, thank you so much.
Thank you indeed, and your comment is right. And I just cautious of time, but I just want to see if anybody else has any other questions.
Of course, yes.
So
I just thank you very much, and thank you. Look forward to talking to you soon.
Thank you. Do you have any other questions? Anyone else has any questions about our presentation?
Hello.
Yes, Bishan.
Good afternoon, Hassan. Thank you so much for the presentation and all the answers. This is Bishan Bhala from Vision Capital. Just a comment, sir. Along the lines of the segmental data breakdown, it would be helpful if you could also provide a split of your investment book in the quarterly statement. You provide the split up on an annual basis, but on a quarterly basis, it would be helpful to sort of get an investment book split up along the lines of what the peers are doing, because that would help us look at the investment book and the split up and sort of what securities you hold and what the concentration in different sectors is. That would be helpful, sir.
Okay, noted down.
Yeah, and just another further thing. I understand it's a transitory year for the company. You've spoken about sort of all the synergies, the challenges, the one-offs, etc. But let's say, looking at 24 and probably even 25, you have a 50-odd million investment book, 55 million real investment book, and the company's done a great job. I would like to sort of point out in terms of the investment income that you generate. And what would be sort of a target combined ratio, let's say in 24 or 25 for the company? Because historically, you've been one of the few players to sort of make a operating profit. So going forward, what would be a target combined ratio? And then I'd build on to my next question.
Okay, thank you. So I'm happy that you're not asking about 2023, because this is a year of happening. So it's a very different year. So in our forecast, in our 3 years business strategy, which has been developed very thoroughly and presented to the board and almost getting approved, we are targeting obviously a positive COR from 2024 all the way to 2026, right? 2024, we don't expect the same ratio that we enjoyed pre-2023, so in 2022 and 2021. Again, because this again, we are not yet completely out of the integration. We'll have some more expenses. We are doing a lot of cleansing of the board and getting to the state that we want to be. But 2025 and 2026, we are looking very similar ratio that we have seen in 2022 and 2021. So between that.
Okay, interesting. That's good to note. And so if I could then look at your combined ratio of, let's say, 95 to 97%, along with the yield that you make on your book, how would sort of the dividend policy for the company shape up? You've mentioned that you're doing a 3-year planning. Historically, the company had a lower payout ratio. Do we see that evolving going forward as a strategy over the next 3 years?
And the dividend strategy.
Yes.
So see, again, when you are investing, heavily into the M&A, then dividend is becomes very important for the shareholders, right? So the expectation is that that dividend needs to be distributed. Again, I'm not a decision making when it comes to this. It has to be decided by the board and by the shareholders. But we will be a dividend paying company. That's what has been discussed at that level. Yes. This is how you make your return on the investment.
All right. That's it from me. Thank you so much and wish you all the best.
Thank you, Vishal. Any other questions? We've got a couple of minutes. All right, so thank you very much, everyone, for being here today and listening to our conversation. I enjoyed the conversation with all of you. Thank you very much.